Risk management is a major topic in trading, and the secret behind a successful trader is good risk management practice. But what exactly does that mean? Let's find out in this video. Hi everybody, I'm Emily from the channel Mindfully Trading, where I share videos relating to trading stocks and Forex, as well as my own personal trading journey. Today we're going to talk about risk, and in particular I'm going to share my own personal turning point with risk management. I was trading small cap stocks when I was studying with warrior trading, and my risk management was really quite poor. Although I was aware of the importance of risk management practice, I didn't quite get it right with my trading, and so my losers were bigger than my winners, and we all know where that leads. From reviewing my trading metrics that I logged, I could clearly see that I needed to improve my risk management to improve my overall trading results. Before I share how I do that, let's just clarify the definition of risk. So what is risk? I know it might seem like the most simple question, but sometimes the simple questions are the most important. When we are trading, we are both winning and losing trades, and the losing trades are inevitable. They cannot be avoided. But the way that we can help to manage these losers is by putting our attention into risk and managing our risk. Another way of looking at it is thinking about what is the most that you are comfortable losing on a given trade, and that is risk. It's being able to cap your losers so that they don't become uncontrollable, so that they don't become huge, and more importantly, so that they don't blow up your account. There are many ways to manage risk, and it can be a very personal choice because people vary with risk and the levels of risk that they are comfortable doing. So the best thing to do is to learn as much about it and then find what feels right for you. And that's what we're going to dive into in this video. When I was trading small cap stocks, I used to think of my risk in terms of currency. So I would be risking, say, £30 on a given trade. But now, thanks to my brother who also trades Forex, I am now focusing on my risk in terms of percentages. And this is really helping me to effectively manage my risk. It's also helping me to manage my emotions, and it's overall been a huge game changer for me. We're going to jump onto the computer and I'm going to share with you a PowerPoint. I'm going to make it as fun as I can, and hopefully it's not going to be death by PowerPoint. But there are some really good tips on here and some really useful insights which I think will really help transform your trading performance by simply focusing on improving your risk management. Let's dive right in. So how do you calculate risk in a trade? Risk, as I said before, it's a very personal preference, and other people may be comfortable taking higher levels of risk than other people who may prefer to be more conservative and take lower levels of risk. I aim to be somewhere kind of in between. You see, I don't want to be reckless, but I don't want to be too conservative either, so I do try to get a good balance when it comes to risk. So one method of calculating risk, as I said before, is through currency, where you are calculating it based on your own currency. So for me, it's the Great British Pound. And it usually follows a set figure. So if you're using, for example, a stop loss of 20 points in a trade, and say that you are risking £40 for that trade in, 200 share position on stocks using your 20-point stop. I use this method when I did trade small cap stocks, as I said previously, and I found it very quick to be able to set a cap on losses, so it was useful for that. It allowed me to get in and out of a trade quickly, which at the time was the strategy. I was scalping quite a lot and I needed to be able to get in and out without spending too much time deliberating on my risk and then missing the move because obviously I hadn't gotten in time. So it was quite good for that, but at the same time I felt that it wasn't quite precise for risk because I was working out too quick in the moment. A second method of calculating risk is through percentages, which is slightly different to currency. And as I said before, it takes a little bit more time to calculate, but I do find it a lot more effective. Good risk management practice is crucial for trading because anything that helps you to cap your losses and keep your account alive is going to really benefit you when you're trading, especially as a beginner. So first, let's take an example of a £500 account. And then if we choose a max risk per trade parameter, for example, 1%, so the maximum amount that you will lose in a trade will be 1% of that £500 account, which works out at £5 risk per trade. So whether your stop loss is 20 points or 50 points or even 100 points, your percentage risk stays the same no matter what that is, because you're not focusing on the amount your stop loss represents, you're focusing on the amount that you are risking, regardless to what that stop loss is. Like I said before, this has been a huge game changer for me. I I really love this quote. Gamblers think about profits, whereas traders think about risk. And it's so important because if you're focusing on that risk, the profits will take care of themselves. Let's throw another example. Say that we have £1,000 account and we're risking 10% per trade. Now this is quite a lot of risk, and this is more similar to what I was risking when I traded small cap stocks. And if you don't know what you're doing, it's a very quick way to blow up your account. But anyway, sticking with this example, £1,000 account risking 10% per trade works out about £100 per trade that you're risking. If you have a loser, you are losing 10% of your account, and that's huge. So I've created this table just to give you an idea, because sometimes, as we all know, there are ebbs and flows with trading, and even the best traders can go for a trading slump where they have consecutive losing days, or simply just consecutive losing trades in a row. Now looking at this table we've got here, I've highlighted 14. Now whether this represents 14 days and you're taking one trade per day, or whether it just represents 14 trades. Now the idea here is that we are looking at 14 consecutive losing trades with £1,000 account risking 10% per trade. And it just gives you an idea of how quickly using a higher risk can really bring your account down when you have those consecutive losers. Day one, we lose 10% and we have £900. But now we are risking 10% on a £900 account, which means day two, after we've had another loser, we now have £810 in our account. So after 2 days, we're down £200 in our account. And you can see how cumulatively the losers really do become big and the account becomes small rapidly. And after 14 consecutive losing trades, from a £1,000 account, we're now at a £228 account. And it really does highlight the importance of risk management, because we can choose to have this, or we can choose to manage it better. Halve the account in 7 consecutive losing trades. That is massive. And as I just reiterate, a bad series of trades which do happen and you don't manage your risk, and it can really bring an account down quickly in a short space of time. So risk must always be relative to the current account figure, and not a randomly generated number that you're constantly losing. And that's why I really prefer this percentage figure, because it really does relate it to your account. Now we're going to take the same £1,000 example, but instead of risking 10% per trade, we're going to risk 3% per trade. And some people would still consider this an aggressive level of risk, because other people prefer to stick to 1% per trade, and that's what I'm currently risking at the moment as well. But I'm going to just share a 3% risk per trade just to compare that with the 10% that we looked at previously. So £1,000 account risking 3% per trade, which works out around £30 per trade that we are risking. The same again, we have 14 here, 14 consecutive losing trades in a row, but this time we're risking 3%. So day one, from a £1,000 account, after one losing trade risking 3%, we are at £970. And then day two, from a £970 account, losing 3%, we're at £940. Now you can see straight away that our account does not go down as quickly as it did risking 10% after 14 consecutive losing trades. And at day 7, when we were risking 10%, we'd halve the account. This time it's at 807. It's a much more manageable figure. And after 14 consecutive losers, we are still above half in our original account balance. So it just shows you a different perspective on how good risk management practice can really help you as a trader, especially at the beginning when you really need to focus on survival rather than thriving. The key to risk is to manage your losers and keep them as small as possible. The key to trading is to focus on risk and not on making money. First, we prioritize risk management and then we focus on money. And again, just to share these with you, I'm just loading up the 2 different ones we've gone through. So on the top row, we have our £1,000 account risking 10% per trade after 14 days or 14 consecutive losing trades. And on the bottom row, we have the same £1,000 account risking 3% per trade. And you can just see the difference here. After day 1, we have an extra £70 in our account risking 3% rather than 10. But by day 14, risking 10%, we are down from £1,000 to £228 in our account. Whereas on day 14, from the same £1,000 account risking 3% per trade, we're down to £652. It's a much more manageable figure, and that's achieved simply from managing our risk more effectively. Another element of risk management, as well as looking at the overall percentage and general risk per trade, is looking at the risk-reward ratio. Now, this is basically a way to calculate your risk per trade, and it's also a way to calculate your losers per trade. So you can take this idea and use it to set a hard stop loss once you get into a trade, but also you can use it to set a hard profit target when you get into a trade. And it's just a really good way to practice trade management as well as risk management. So for example, if we have a 1-to-1 risk to reward ratio, we are risking 1 to make 1. So whether you are using currency and you're risking £20 to make £20, or whether you're using percentages and you're risking 1% to make 1%, that's the general idea of this. 1-to-1 is not profitable because it relies too much on accuracy per trade. You basically have half of a chance of making money or losing money. So you really need to focus on your accuracy to make money and be profitable, because we know trading is a game of probabilities. So what can we do in a game of probabilities to increase our probability of winning? Well, we can increase our risk reward ratio, and this basically means that we are risking less than we are aiming to win. So for example, if we risk 1 to make 1.5, we would maybe risking 1% to make 1.5%. So this could mean that if we have 2 consecutive losers and then 2 consecutive winners, that we are still green on that account because we have increased our profit or our reward in the risk reward ratio. But a much better way of managing our risk reward ratio is using the 1-to-2, and this means we are risking 1% to make 2%. Or if you prefer to think of it in currency, we're risking £20 to make £40. And this means that we can take 2 losers and only have 1 winning trade, and we can still be break even on our account. Because, for example, if we've taken 2 losing trades and say they have a value of £50 each, so we've lost £100, but then we take 1 winning trade, which, because we are using a 1-to-2 risk reward ratio, we've actually won £100. It means that even having 2 losers and 1 winner means that we're break even on the account, and it really does help to increase our profitability as a trader. So how do we use this risk reward ratio? Well, once you've determined your risk reward ratio based on your strategy, so for example, if you are scalp trading, you may prefer to have quite a small risk reward ratio. So for example, risking 1 to make 1.5. If you're day trading and holding a longer position, you may be comfortable risking 1 to make 2. And if you're swing trading, you may even have a higher risk reward ratio. So you may be risking 1 to make 3, or maybe even risking 1 to make 5. It really depends on your strategy and the range that you believe your trade has potential to achieve. And you can use this to set orders for trades. Now, I use this really handy tool by TradingView. If you've not heard of TradingView, they are a charting platform. I've got a little link above where I give a video review of them, and I highly recommend them. They are very, very good. And in this instance, as I said before, I use their handy tools to calculate my risk and reward. And this is just a screenshot from a trade that I took recently. As you can see, the middle line between the red and the green, that is my entry point. And then I'm using a 40 pips stop, and I'm aiming to make 61 pips, but 60 pips. And it's basically the 1.5 ratio we talked about. So I'm risking 1 to make 1.5% on my account. So it's just quite a handy visual tool you can use, because you can drag the different stops and targets, and you can see how they are relating to the price action prior to that, if they match up with key support and resistance zones. So it's really useful to help manage your risk by using this risk reward ratio. And a couple of bonus tips for you just before we summarize this PowerPoint on risk management. I mentioned them before, but it's definitely good to use hard stops and also hard profit targets as well. To ensure that you are following your plan and managing your risk, hard stops will really help, because they help to take the emotions out of it. If your trade's going against you and it's coming to a stop, but you've not set a hard stop, it can be quite hard to actually execute that order that gets you out the trade. But if you've already set a hard stop in place so that when it hits that point, it automatically takes you out of a trade, then you don't have to do anything. You just have to let it work. And that's a lot easier than having to do something in a potentially emotional situation. Makes it more automatic. And another tip is also setting a max daily loss. And this is a really good tip as well. And it's more so for day trades rather than swing traders. But it helps to manage the overall loss on your account by sticking to a max daily loss. So for example, 3 times your risk per trade. So if you're risking 1% per trade and you've hit -3% in your account on that day, then you know that that's the point where you recognize that it's just not your day, and good risk management practice is to just walk away, turn the computer off, and say that you're done for the day. And that's the concept behind the max daily loss. If you hit it, you stop trading for the day and you live to trade another day. And finally, it's really helpful to follow your trading plan. Remember to follow your trading plan, because every trading plan should also have your max loss per trade as well as your max loss per day. So a good trading plan will have these risk management principles in place, as well as other elements of a good trading plan, such as your strategy and also your different technical indicators and anything that you decide to put into your trading plan. I do have a free trading plan available. It shares my trading plan, and there's also template pages in there so you can help to formulate your own trading plan. I'll put a link to that below in the description, so if you want to check that out, it's completely free and you can download that from my website. I really hope you've enjoyed this introduction to risk management. If you've got any questions or any comments, do leave them below. And if you have enjoyed it, please drop me a like, because it really does help me to grow my channel. Also, don't forget to subscribe if you're not already subscribed to this channel. Thanks, guys. Bye.